So what's going on now? Why is crypto so shaky? It's the same reason tech's been shaky. It's liquidity, stupid. Liquidity is the big driver of all asset classes, and particularly crypto. It's the most receptive to liquidity injections or withdrawals. So I correctly managed to time the bottom in 2022 based around the liquidity cycle. And the forward-looking elements of the liquidity cycle continue well into 2025. So I don't have anything to concern over. So therefore, we're looking at the wiggles in liquidity.
When Bitcoin rose to a new all-time high of over $73,000 in March, more than a full month before the periodic halving event, many people expected that the unprecedented demand from the spot Bitcoin exchange-traded funds would continue to push prices to new highs, or at least hold them steady above $70,000. However, the going has not been as good as expected. Instead of new all-time highs and massive gains, the cryptocurrency market has been experiencing quite a lot of turbulence. According to Raoul, a renowned macro analyst, crypto enthusiast, and former Goldman Sachs executive, the cryptocurrency market has been negatively impacted by global liquidity conditions, which have been especially worsened by the Federal Reserve's tightening policy. While Powell believes the turbulence could last for a while longer, he is certain that the Fed will soon ease up on the tightening, then swiftly announce a policy reversal that will, among other things, restart the crypto bull market. Since at least last year, Powell has an important warning/advice for cryptocurrency investors. Don't f this up. Hold, don't use leverage, expect and ignore drawdowns, and watch patiently as this entire market gets bigger than we can imagine. Powell has preached this message again and again in the past year. In his latest video broadcast, Powell gives a much-needed update about the current state of the bull market and what we can expect going forward. As we bring you clips from Powell's highly insightful video, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also join the conversation by dropping your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
In the last 12 months, you've probably forgotten this, but this is our fifth or sixth 20% pullback in Bitcoin. So you've dealt with this many times before. You just kind of forget it, which is weird. And I think Coinbase put out a super interesting tweet, which was, there have been 5 Bitcoin bull markets. In an average bull market, you'll have to survive the following to ride it to the top. 6, 5 to 10% drawdowns, 3, 10 to 20% drawdowns, 2, 20 to 30%, 1, 30 to 40, 1, 40 to 70. And that's all during a bull market. So it takes a certain kind of gumption. It takes an ability to turn off Twitter, to turn off your screens and say, has my thesis changed? Is the adoption of this technology stopping? Is there any other reason that it's going to slow down? Where are we in the business cycle? I spend enormous amounts of time trying to educate you guys that this is a macro asset and it's driven by the business cycle. Just happens to be forward-looking, like technology stocks, and it's driven by the liquidity cycle. So has something changed in the business cycle that would tell us that we're going to have a failed crypto cycle? Well, in all probability, that's a no. So therefore, it's corrective price action. And if you happen to have extra money on the sidelines, use these corrections to add. That's what I did. I was lucky enough to have a bit of cash, and I added to my Solana position. Great. And I found that compounds really well over time. It's a key way to make better returns out of this space is use the drawdowns to your advantage. Even the big cyclical ones. I didn't sell out of anything last time. I had no intention of it. It wasn't like I missed the top or anything else. I knew that to get back in is really hard. If you take X sum out, you never put X sum back in again. You go smaller because you don't want to risk it all. Your whole psychology is screwed up. So what I prefer to do is say, well, this is a longer term trade. When we get the big drawdowns, I just want to add. And then you compound and you're back to all-time highs well before the market is. And that is really, really a superpower. So what's going on now? Why is crypto so shaky? It's the same reason tech's been shaky. It's liquidity, stupid. What's happening? If you think about the US liquidity, it's driven by the Fed's balance sheet, which they've been doing QT, so they've been tightening it, making liquidity less available. But that's been offset by the Treasury, by the draining of the reverse repo. The reverse repo is an offset to what the QT was doing. And in the meantime, the other part of the equation is the Treasury General Account, which is the checkbook of the US government that Janet Yellen controls. And she's been building that. But these have meant the liquidity based back in 2022, and it's been going vaguely higher. The everything code cycle taught you that There is no way of financing the debts. It's now become a word people use, fiscal dominance. This is the everything code cycle I started talking 2 years about. The everything code cycle says, well, if GDP growth is too slow, then the amount of debt in the system is too high. So you need either interest rates to come down or you need growth to go up. Now, growth is driven by demographics over time. There's not much we can do about that. You get cyclical growth, but you don't get the overall trend rate growth, which has been slowing. So the available GDP has to pay the interest on the debt between the government sector, that's 100% of GDP in debt, and the private sector is 120% in debt. So we've got not enough GDP to cover the interest payment. This gets really exacerbated when interest payments are high. Trend rate of GDP growth is about 1.75%, call it 2%. Whilst interest payments right now are, let's say, 2-year bonds are 5%. Okay. And then if you double that, taking into account the private sector, you've got 10% of interest payments and nominal GDP growing at whatever it is, 5. So there's not enough GDP, which is why the bond market's been freaking out.
Earlier this week, the Fed said that beginning in June, it will slow the pace at which it allows maturing bond proceeds to roll off its balance sheet without reinvesting them. This means the Fed will be slowing down on QT. According to experts, this is a backdoor easing of monetary policy, signifying that the Fed knows it must cut and start easing as soon as possible. But the central bank is dragging its feet to fool the market for a little more time. Powell believes the deceit can only last for a little more time. Soon, the Fed will be forced to come out outright with its plans, and when that happens, crypto asset prices will soar significantly. Let's get back to Powell's video.
This is the issue of not having enough GDP growth. This is the everything code cycle. So what it leads to is what's known as more cowbell, which is stimulus. Stimulus can come in a number of ways. So the most obvious way is reducing interest rates themselves. That has been a typical path. The other way is the backdoor mechanism of injecting liquidity into the system. Quantitative easing is the best known one. The other one is draining the reverse repo and also draining the Treasury general account. So those tend to be those, and then there's some more coming, and I'll come into that in a sec. So where are we today? Why did we have the air pocket? Well, QT was going on, so they're selling bonds. The Treasury had started building up cash reserves because tax payments have come into the system. They come out of money market funds and go into Janet Yellen's checkbook, checking account. And that's taken liquidity out of the system because she hasn't spent it yet, so it's just sitting there. She's been trying to help the market by issuing short-dated bonds. That's drained the reverse repo. But now today, the market's reversed very quickly on another piece of news. The other piece of news was Jay Powell has said, hey, we don't want to sell as many bonds, quantitative tightening, which is we're going to ease liquidity condition. Janet, on the other hand, hasn't said that she's going to issue more short-term bonds yet. Well, it's a bit impossible because the reverse repo is almost drained anyway. She's going to wait till closer to the election to unleash her checkbook and throw out money to everybody. And she will do that, and that will come in the second half of the year. So what she's done is another bit of magic. She said, well, what I'm going to do is I'm going to keep issuing these shorter dated bonds, and I'm going to buy back some longer dated bonds. And it's the illiquid off the run ones. But really, it's a recycling of liquidity. It's adding liquidity into the system. So Janet started to add liquidity, and Jay is making sure that he takes less liquidity out of the system. The reverse repo is almost drained. There's a bit more to go, but then it'll come down to Auntie Janet, and she will then start throwing her checks around and handing out money. There's another piece of magic coming for next year that's not on people's radar screens, which is Basel IV. Basel IV, the Basel agreements are basically bank capitalization regulations after the banking crisis. They imposed Basel III, which meant people had to hold more regulatory capital. That is code word for owning more government bonds. Basel IV is going to tighten that even further. So they're going to force the US, the UK, and the European banks to hold more government bonds. How convenient, because you need a buyer of the bonds to add liquidity into the system. And so that is coming. It starts with Europe, I think, in January 2025, and the US and the UK will come by about June, July 2025. So there's liquidity coming in the system at a structural level, i.e. they're creating another larger buyer of bonds. We will see more of those kinds of things over time, and we're going to get much more liquidity. But this is just the Fed. Over in Europe, well, the ECB want to start cutting rates soon. That's going to start injecting liquidity into the market. They're also still planning their big green energy initiative to lower the cost of electricity in Europe, which is actually good for productivity. In the UK is similar. They blew up their gilts market last year. They will do some injection of liquidity for sure, whether it's via rates or whether they can find a backdoor excuse to do something else. Obviously, Basel IV for all of these helps. Japan. Japan has got a real problem on its hands. Its currency is falling fast. And there's very little they can do. They don't want to raise rates too much because their GDP is too slow. They've got the everything code issue at hand as well. So they've got this problem. China's also got the same problem. It's starved of dollars. It has a bunch of dollar debts. It has a debt deflation going on, particularly in the property sector. It's an unbalanced economy. They need dollars, and they can see Japan losing control of its currency. They're nervous about that. Janet Yellen's been over there twice because she's worried that if China devalues, they're going to dump deflationary goods onto the US and create other problems. So somewhere here, there needs to be an injection of dollar liquidity into the system, whether that's via swap lines or some other backdoor mechanism to alleviate the strength of the dollar.
We are in the thick of a cryptocurrency bull market. But like everything crypto, that means quite a bit of volatility, just enough to cause 20 to 30% drawdowns, but nothing that'll leave any permanent damage. According to the Coinbase tweet Raoul Pal references in his video, hodling means taking the price declines in your stride, both during the bear and bull markets, and knowing that your patience will be handsomely rewarded in the long term. So you think you can hodl? Here's what it means. The first post reads, "Crypto bull cycles hit different. The past 2 bull markets lasted 3.5 years. We are 1.5 years in. The past 2 bull markets saw prices increase 113x and 19x. Prices have increased 4x. There have been 5 Bitcoin bull markets. In an average bull market, you will have to survive the following to ride it to the top: 6.5 to 10% drawdowns, 3.10 to 20% drawdowns, 2.20 to 30% drawdowns, 1.30 to 40% drawdown, and 1.40 to 70% drawdowns, all during a bull market. When do you think liquidity conditions will turn, and how do you expect it to impact Bitcoin and other cryptocurrencies? Please share your thoughts, comments, and observations in the comment section below. Also, ensure you give this video a thumbs up, subscribe to the channel, and turn on the notifications bell for more videos like this. Thanks for watching.